Welcome back to Market on Close. We got a little less than 10 minutes till the bell rings. Stocks are having some trouble. You can blame some of it on Apple, blame some of it on Oracle. Tech hasn't been having a good day. Tomorrow's inflation, that's the highlight. Let's bring in our big picture panel team. Randy Frederick and Liz Ann Sonders join me. Liz Ann's the Chief Investment Strategist and Randy's Managing Director of Trading and Derivatives. Afternoon team. You know, it is kind of a busy week here. We've been talking about the Apple events all day. Tech just kind of having some trouble. Tomorrow's inflation and oil keeps ripping. I guess we should start there, Liz Ann, as we had a conversation in the last week about the impact of higher energy prices. Are we getting to pain points yet here?
We could be, certainly, if the decline, if the surge is not arrested. History is more than littered with incidents of oil prices, not in and of themselves, but when you see a spike like this bringing on a recession. And I think that's a risk this time. I heard a comment today, well, oil is doing the Fed's job for it. I'm not sure I would see it that way. I don't think they're going to adjust policy because of oil prices. But you did see we haven't seen any change for expectations or probabilities around the September meeting, but throughout the day, you did see an easing in the probabilities of a hike in November, down now to only about 38%. That could have something to do with the tightening effects that higher oil prices bring into the mix.
Yeah, it's problematic, I guess, kind of no matter how you slice it, just sort of the degree to which, if it's going to be a big problem or if it's just a little nuisance. When you think about how it informs tomorrow's print and the market's reaction to inflation compared to the first half of the year, do we stand to see some changes, Randy, in terms of kind of the ease with which we digest inflation numbers?
Well, I think Liz Ann's right. When you talk about oil prices, it's going to cause obviously a little bit of impact on consumer spending. It's going to hamper people's budgets just a little bit. The chance of a rate hike next week is virtually zero. And the probability of a hike going out to November, as she said, has been coming down. I think the market has priced in one more hike for this year. It's just a matter of which month we get that. It looked like it was going to be November for a while. Now we're probably talking about potentially December. So if we get one more, no big deal. I think the markets are good for that. As far as inflation goes, if we get a little bit of an uptick, which I think we're going to get at least in the headline number because of the price of oil, we'd have to get a print above 4 to get all the way back to really where we were just in the summertime. So it's not that crazy. Yes, we had a little bit of an uptick last month, but keep in mind we had 12 consecutive downticks. So we really would need a substantial multi-month tick higher to get us back to where we were earlier in the year. And remember, the market was higher earlier in the year than where it is right now. So I don't necessarily think that derails the markets. And as long as the labor market continues to be strong, and we know that it is because last week, Thursday, we got the lowest weekly claims number since going all the way back to January. So even though we see some cooling in certain areas in the labor market, the overall picture still looks pretty good. And as long as people are employed, as long as they've got money to spend, it will simply cool things down a little bit, which again is what the Fed is frankly trying to engineer.
Yeah, fair enough. So no hike next week, but the commentary, Liz Ann, if we keep getting some of these pressures, might we see a little bit of tilt in Powell's commentary towards maybe, warming us up to the idea of something happening before the year's out?
I think he could reinforce the notion that meetings going forward are still live. He's not going to provide precision on is it November, is it December, but I think he'll keep that option on the table. Oliver, as you and I have spoken about, I think the more interesting issue may be if he pushes back on what are still about 4 rate cuts expected in 2024, and if he feels that he needs to reinforce the for longer part of higher for longer. Yes, if the Fed goes on hold, even if they have one more hike, if we continue with disinflation, that means real rates go up. But I think absent further deterioration in the labor market, that is not going to provide the green light for the Fed to literally pivot from the most aggressive hiking cycle to, in short order, starting to lower the Fed funds rate. I still think there's probably a longer span of time between whatever the final hike is and whenever they have the green light to start cutting again.
Yeah, it's a good reminder that we still have multiple cuts priced down. I mean, it's just still kind of it's flabbergasting a bit. It's, seemingly we should get to the 1 if that's going to happen. And then think about whether or not there's multiple. We haven't even gotten, it's like first a binary thing and then how many, right? We haven't even gotten past the binary phase where we're even in the cuts. So to your point, it feels like Powell would have to push back on something. I mean, the VIX right now, as low as it is, Randy, I feel like kind of speaks to that. That's probably playing a role keeping the market fairly complacent. I mean, pretty amazing. We've been hanging out at like 14, 15 handles.
We have, and that really speaks to just a daily move of around 30, 32 points per day. And frankly, if you go to look at the daily moves in the S&P for the last 6 weeks, it's averaged only about 26. That's about 0.5% a day. No big deal. When you see VIX this low, what it's telling you is that anytime over the next month or so, there's just really a very low expectation of a big market move. So no one's really expecting that to happen. And as Liz Ann said, I mean, just the fact that the market's pricing in cuts for next year, the market was wrong for the entire second half of this year when it was pricing in cuts, and now that's been pushed out. Explain how, if the Fed's target is 2%, why they would have any incentive to cut rates unless inflation gets down to that level. What we're talking about now is concerns about inflation ticking back up, not about it falling too quickly. So I don't think that's going to happen. And again, given where we're at, a sideways market to very modestly higher for the remainder of the year is really what the VIX is telling us. No one is that anxious of a big major market move right here.
Seasonality tells us what, Randy? I know that you got some notes on that subject. I want to make sure we hit that real fast because it's not typically a great time of year for bulls.
Right. And again, seasonality is one of those things you should take into account with all the other aspects of your trading plan. But September notoriously is the worst month out of the year. It's been a down year for 4 consecutive years. But here's a key point I want to make. When the market is up between Memorial Day and Labor Day, which is that sell in May and go away period, which it was this year, the market tends to end the year higher 88% of the time. So even if we get a slowdown here in September, which is not unreasonable, by the time October comes along, which is just a couple of weeks from now, things are probably going to start trending a little bit higher.
All right. Like the convo. Great stuff, guys. Nice teamwork. Liz Ann Sonders, Randy Frederick, thank you very much.